We all know the market is unpredictable, yet governed by expectations of underlying forces of companies and economies. In this video, we'll examine how the federal funds rate, the unemployment rate, and the yield curve are connected and how they have behaved during past U.S. recessions. Also, let's check what happened to the S&P 500 in these periods. While these indicators cannot guarantee perfect timing, they can offer essential context for understanding market cycles. These economic barometers, when analyzed together, can offer crucial clues about where the market might be headed. From predicting recessions to identifying potential bull markets, their interplay is a key to unlocking the market's mysteries. Let's dive in. Let's start with the federal funds. The federal funds rate is the interest rate at which depository institutions trade federal funds. The federal funds rate is the central interest rate in the U.S. financial market. It influences other interest rates such as the prime rate, which is the rate banks charge their customers with higher credit ratings. Additionally, the federal funds rate indirectly influences longer-term interest rates such as mortgages, loans, and savings, all of which are very important to consumer wealth and confidence. For the last 60 years, every time the federal funds rate had a move up or was kept high for a long time, a recession followed. Now, how is that related to the unemployment rate? Well, let's see. The unemployment rate represents the number of unemployed as a percentage of the labor force. In a high inverse correlation with the federal funds rate, when the rate goes up, the unemployment tends to decrease. It doesn't happen immediately. It takes a while before the rate impacts the economy, but it does happen in some degree. If the unemployment rate reaches a level too low, where the abundance of jobs start to raise salaries and consequently increase inflation, the Fed starts considering to increase the federal funds rate in order to keep inflation stable. What about the yield curve? Well, the yield curve has a long history of predicting recession, since it happens a few months before the recessions. The yield curve represents the interest rates for different maturities. In this chart, we can see the 10-year Treasury minus the 2-year Treasury. Every time the result goes beneath the zero line, it means the market is willing to pay more for a short maturity loan than for a long maturity loan. This is called a curve inversion, and it's interpreted as dangerous times. Similarly to the federal funds rate and unemployment rate, the inflection points of the yield curve tend to happen around the same period. Great. The correlations are pretty clear. Now, what happened to the S&P 500 when these inflection points appeared? Let's check closely at the last 3 recessions based on the yield curve inversion point of reference. Excluding the COVID recession, since it was not a cyclical recession. In the recession of 1990, the yield curve inverted in December of 1988. Following the inversion, the market went up around 40%, and it only had a reasonable correction 18 months later, in June of 1990. In the recession of 2001, the yield curve inverted in February of 2000, while the S&P 500 stayed flat for 7 months, before starting a downtrend of 2 years and 48% of drawdown from the peak. In the recession of 2008, the yield curve inverted in January of 2006. Following the inversion, the S&P 500 still had an uptrend of 26% for about 9 months, before starting a downtrend that lasted 15 months and a drawdown of 56%. From the yield curve inversion of December of 1998 to August of 2024, the day I'm recording this video, the market has experienced 4 major recessions, including the COVID crisis, and still increased its value in 1,800%. If your investment style is buy and hold, you might not need to closely monitor these indicators and can focus on dollar-cost averaging during market corrections. However, if minimizing significant portfolio declines is a priority, understanding these indicators can be of great help. Thanks for watching. This content is for informational purposes only and does not constitute financial advice. Subscribe to the Great World of Finance for more investment content. Stay tuned. Level the game.